What are your most frustrating trading moments? If you're anything like me, it won't take you long to answer. There are certain trades that just seem to linger in your memory, like a bad taste, just as vividly as your biggest successes. Like the one that haunts me the most was from back in 2014, about 10 years ago now. I was holding a short trade on the euro. Decent position size, I had over 30 lots open. The technicals gave me a solid entry around 138, and the fundamentals were suggesting that we could reach at least 120, so potentially a huge move. But I was worried that if we broke 140, it would lead to a surge of momentum, and I didn't want to be on the wrong side of that. You know how it tends to be around these sort of major levels. So that's where I capped my risk, just below 140. And time passed and the price didn't really do much to start with, not this bearish meltdown that I was hoping for. But then price did start moving. It started creeping higher, not what I wanted it to do. And eventually a sudden jolt just sent it driving towards 140 and took me out of the trade. But the thing is, the price didn't quite reach 140. It got above 1.399 something and then started falling like a cannonball. And in the following months, it not only reached 120, which is what I was expecting, but it dropped all the way below 105. Over 30 lots at a 138 entry. I'm sure you can imagine that trade felt like a double loss. There was the real capital I lost on the trade when it hit my stop loss, and then the missed profits, which would have been anywhere between 500,000 and £1 million, depending on where I exited. And I still think about it to this day. It haunts me 10 years later. But I'm not the only one. Whenever I meet up with other traders, the conversation always finds its way to our favorite trades and the ones that got away. And there are two main categories of those frustrating trades. There are the missed entries that would have been huge if you took them, and then the ones that you exited at the wrong time. Either a great profit that you held too long until it disappeared into dust, or the ones that you exited too early, just like my euro gut wrencher. And usually it's due to a mistake that you've made. If it wasn't, it probably wouldn't bother you as much as it does. What makes them so frustrating is that you should have known better. This is Simon Ramo, a scientist who's known as the father of the intercontinental ballistic missile. Alongside writing about things like microwaves and space, strangely, he decided to write several books on tennis. And he made an important observation. He said, in expert tennis, about 80% of the points are won. In amateur tennis, about 80% of the points are lost. In other words, professional tennis is a winner's game. The final outcome is determined by the activities of the winner, and amateur tennis is a loser's game. The final outcome is determined by the activities of the loser. So if you're an amateur and you're playing against another amateur and you want to win, then rather than trying to play winning shots, the most successful strategy is to focus on making fewer mistakes. And funnily enough, trading at an early stage is quite similar. You see, early in your career, after you've learned the foundations, like the necessary skills and concepts, the biggest impact on your trading performance won't be your moments of genius. Instead, the biggest impact will come from your mistakes. And I'm not talking about times when the problem is a lack of knowledge or a lack of skill. Those wouldn't really be mistakes. Instead, most traders lose money overall because they make mistakes that they know they shouldn't be making. So why do you make these sorts of mistakes if you should know better? Well, there are three key reasons. Firstly, there are really common skill-related problems that most traders aren't even aware that they have. And these have a major impact on your trading psychology, which then increases the chance of a range of different mistakes happening. And I explained this in an earlier video, which you can click up here to watch. And usually by resolving these skill issues, you'll reduce the psychological problems, and this will stop you from making those sorts of mistakes. Secondly, we have the emotional aspects that are not related to how you approach the skill. As the trading psychologist Denise Scholl says, BIKB, but I know better trades, set up feeling and emotional contexts, and also emerge from conscious and unconscious emotional contexts of self-recrimination. Just catching yourself in those and the feelings surrounding them will impact your bottom line in a positive way. Knowing the feeling cluster radiating in your psychological environment gives you the chance to evaluate whether it signals a risk to be managed or an opportunity to take advantage of. So in other words, you need to track when those mistakes are happening and take note of the feelings that emerge during that time. And by doing that, you can recognize those situations in future in real time and evaluate the situation more correctly. And this is something I'll explain a bit more in a separate video. But the third reason is by far the most troubling, because it can happen regardless of how experienced you are or how great your trading usually is. As Donald Rumsfeld famously said,
"There are known knowns. There are things we know we know. We also know there are known unknowns. That is to say, we know there are some things we do not know. But there are also unknown unknowns. The ones we don't know, we don't know."
It's those bloody unknown unknowns. So many of our mistakes are due to cognitive biases and mental blind spots. We're not even aware that we're making these mistakes. We don't know that we're doing something wrong, and they affect all of us. Research by Daniel Kahneman and other psychologists has revealed that we all have these blind spots and these biases regardless of our level of intelligence or IQ or anything else. Here's one of the tests that they use. Jack is looking at Anne, but Anne is looking at George. Jack is married, but George is not. Is a married person looking at an unmarried person? A, yes, B, no, or C, cannot be determined. So have a think about it and pause the video if you're not ready for the answer yet. Okay, so most people answer C, cannot be determined. Here's another question for you. A bat and a ball cost $1.10 in total. The bat costs $1 more than the ball. How much does the ball cost? Okay, again, pause the video if you don't want the answer yet, have a think about it. So in this case, most people answer that the ball costs 10 cents. Is that the same as what you got? Even if you test the most intelligent people in the population, the majority will give those answers that I just mentioned. But the thing is, both of those answers are wrong. For the first question, the answer is A, yes. And for the second question, the answer is 5 cents. The reason most people answer those questions wrong is because of the mental blind spots that we have. And most people won't notice until after the answer is revealed and they start trying to figure out why that's the right answer, and suddenly it's so obvious. Otherwise, they wouldn't have thought twice about it. And obviously this activity is meaningless, but think about how many other areas of your life or your trading this same thing's happening and you're making a mistake and not realizing until maybe it's revealed to you. And this brings me on to an important caveat. The psychologist Keith Stanovich and his team discovered one advantage that intelligent people have. If you explain how they might go wrong before they answer the question, they perform a huge amount better. So for example, for the first question there, they're simply told that they need to use disjunctive reasoning, and that leads to them performing much better getting the right answer. So this gives us an important insight. We don't necessarily need to know the specific mistakes that we're likely to make. We just need to anticipate the ways we might go wrong that lead to the mistakes, the incorrect ways of thinking that we need to avoid, or the correct ways of thinking that we might neglect. Now, that might sound simple on face value, but if you try it, you'll quickly realize that it's one of these things that's easier said than done. But there are strategies that you can use, and to help you with that, here are 3 things that I've found to be the most effective. So let's start with this one. Every trader is told they should keep a trading journal, and to be fair, I think most traders do for a while. They'll try and give it a go, but very few traders manage to stick with their journal and use it effectively over the longer term. Even people that keep a trading journal tend to just write in it after a trade or at the end of a day or a week, but then don't come back to it and use the information that's in there. But I believe that a trading journal is the most underrated and underutilized tool for improving your trading. By keeping a trading journal, you can identify the mistakes that you're commonly making and then find ways to anticipate them better in future. Like you might create checklists to help you overcome problem areas, or give yourself reminders or alerts before entering a trade to point out where you might go wrong. And those are just the obvious things. But the benefit of a trading journal for avoiding mistakes goes much deeper than that. You see, journaling is a form of self-reflection, and self-reflection has been proven to be an extremely effective way to improve decision-making and problem-solving. As I mentioned earlier, we all suffer from cognitive biases, mental blind spots, and other cognitive errors. And research has linked self-reflection with a reduction in these common biases and errors. In fact, it can even lead to neurological changes taking place in your brain that will lead to you being more effective with your decision-making in future. The key to this is to be as detailed and introspective as possible. Don't just take a few short notes about the trade. Instead, explain exactly what you were thinking, why you took the action or made the choices that you did. How were you feeling at the time? What could or should you have done differently? And if you're not sure where to start with the trading journal, or you want to see how you could do it better if you're already keeping one, Check out the link in the description box down below to the free guide that we put together for you. It will walk you through exactly what you need to include in your journal, how to structure it, and all of the benefits of each section. And this is how I keep a trading journal. So if you want to imitate how I do mine, that's the link you need to follow. And you don't have to just limit this to your trading decisions. In your day-to-day life, you could also make use of a decision journal. This is what Daniel Kahneman has praised as being the single best thing someone could do in the markets to improve their performance. He says, go down to a local drugstore and buy a very cheap notebook and start keeping track of your decisions. And the specific idea is, whenever you're making a consequential decision, something going in or out of the portfolio, just take a moment to think. Write down what you expect to happen, why you expect it to happen, and then actually, and this is optional, but probably a good idea, is write down how you feel about the situation, both physically and even emotionally. Just how do you feel? I feel tired, I feel good, or this stock is really draining me. Whatever you think. The key to doing this is that it prevents something called hindsight bias, which is no matter what happens in the world, we tend to look back on our decision-making process and we tilt it in a way that looks more favorable to us. So we have this bias to explain what has happened. Okay, next up we have prospective hindsight. This is also sometimes known as a premortem analysis. In fact, I prefer that term. And it's basically a cognitive strategy where you assess all the potential outcomes, all the possible risks and failures before taking a decision or an action. And this is a great way to anticipate where you might go wrong and then prime your brain to avoid those things, as well as having a bit of a plan for it. So think about a post-mortem analysis. This is where you analyze a situation after it's happened and try to learn from it. So with a pre-mortem analysis, you're basically trying to do this, but before the event has taken place. You're imagining the event has already happened, it's ended, with a negative outcome, and then brainstorming all the possible reasons for it turning out so badly. So basically, rather than asking yourself what went wrong, you're actually asking yourself what could go wrong. And you're then running through all the potential issues that you might not have considered otherwise. You're encouraging yourself to be pessimistic and to think through all of the potential catastrophes. You know, one of the challenges that we face as traders is our own personal biases, which we can simplify as being optimism or pessimism in particular situations. And these biases are often referred to as internal context because they shape the way that we perceive the world around us. And we all have slightly different internal context, and therefore we'll perceive things in slightly different ways. But this can also lead us to miss vital information or think of important things as being inconsequential. So prospective hindsight helps us to set aside those biases and examine potential risks much more objectively. All right, on to the third one. So a few years ago, someone left a comment on one of our YouTube videos, and they were complaining that in those videos around that time, I was explaining what not to do in the markets, but they didn't want that. They wanted to be told exactly what they should do. And you'll see this throughout the online trading community. People will watch videos of other people explaining their secret sauce, the specific rules and strategies that they use to succeed, and then they want to try and implement it as well. But if you're like me and you're skeptical about most of these successes that you see online, you might not see much value in listening to someone else's advice about what you should do. But on the other hand, these people are far less likely to be lying about their mistakes and failures, and that's where I believe the value is. As Charlie Munger famously said, all I want to know is where I'm going to die, so I'll never go there. This is the premise behind the inversion market model, which we discussed in a previous video, and you can click up there to watch it. If you do follow the previous tips that I gave you and journal your decisions with more detail, you can learn from your own mistakes. But most traders miss out on learning from the mistakes of others. And learning from other people's mistakes has been shown through research to be one of the best ways to make even fewer mistakes yourself and become a better decision maker. That's part of the reason that the Duomo community is so powerful, because it gives people a chance to learn from other people's mistakes and successes as well. I mean, just think back to the insight that we gained from earlier. When faced with a problem to solve, intelligent people perform a huge amount better when they're told the ways that other people tend to go wrong. So if you analyze other people's mistakes, it can help you to anticipate and avoid those mistakes yourself. So next time you're watching a guru online, maybe spend more time breaking down the things they did wrong and learn from those instead. But if you want my opinion, there's one major mistake that I see almost all traders making, and solving just this one mistake could already get your trading on the right track. and I explained it all in this video here, which you should watch next. Thanks for watching.